Half the internet says IULs are the smartest tax-free wealth vehicle the rich don't want you to know about. The other half, Dave Ramsey, the finance Reddit guys, your cousin who took one personal finance class, says it's a scam designed to line some agents' pockets. Here's the part nobody tells you. They're both right. They're just describing two completely different policies and calling them the same thing. I'm going to argue the critic side better than the critics do. Then I'm going to show you the line where their argument stops being true. Stay with me. By the end, you'll be able to look at any IUL and know which one you're looking at. I'm Michael Ducille. I'm the insurance architect. And now, I don't lead with that title to sound clever. I lead with it because it tells you my incentive. A broker gets paid to sell your policy. I get paid to design the right structure for your situation. And sometimes that design is, you don't need this product at all. That's the difference that makes this video possible. I can tell you the truth about the IUL because I'm not depending on you buying one. So let's do the honest thing first. Let's make the case against it. If you ever heard IUL is a scam, you've heard some versions of the 4 arguments. Now I want to be clear. These are not straw men. These are real and most of the time, they're correct. 1, the costs are real and they rise over time. An IUL is built on a life insurance chassis. That means there's a cost of insurance baked in, and that cost goes up as you get older. If the policy isn't structured and funded correctly, those rising costs can quietly eat the cash value. A salesman shows you the 5-year illustration. He doesn't linger on year 30. That's important. The second one, your upside is capped. You are not in the market. This is the one the hype guys gloss over. An IUL credits you based on an index like the S&P 500. But with a cap and a participation rate, if your cap is 10% and the index returns 18%, you get 10%, not 18%. So when someone tells you market growth tax-free, that's not the whole sentence. You get limited growth with a floor protecting your downside, which is a real trade-off, not a free lunch. The third thing, and it's complicated, and complexity hides behind bad deals. Caps, participation rates, index segments, cost of insurance, surrender periods, illustration versus guaranteed columns. Most people who own an IUL cannot explain how their own policy works. And anytime a product is too complex for the buyer to evaluate, it becomes easy to sell them a bad version of it. The fourth one, and this is the big one, most IULs are sold wrong on purpose. What I mean by that, max death benefit equals max commission. So here's the mechanic the industry doesn't advertise. An agent's commission is tied to the death benefit. So if an agent maxes out the death benefit relative to your premium, he maxes out his check. And he minimizes the cash value that's supposed to be the whole point for you. The product gets designed around the agent's paycheck, not your outcome. So when a critic says IUL is a scam, honestly, for the policy they're describing, they're right. A complex, overcosted commission max policy sold to someone who doesn't understand and won't fund it properly. That's not strategy. That's a trap. Now, here's where the argument stops. Every criticism I just made is a criticism of how the policy was designed and sold, not of what the tool can do when built correctly. Think about it like this. If a contractor builds a house on a bad foundation and it collapses, the lesson isn't houses are a scam. The lesson is the house was designed incorrectly. So what does a correctly designed IUL actually look like? 3 things. 1, minimum death benefit, maximum funding. Instead of maxing out the death benefit, you structure it at the lowest death benefit the IRS allows for your premium. That slashes the cost of insurance and pushes your money into cash value growth. It also slashes the agent's commission, which is exactly why most agents don't do it. A design policy is built to be efficient, not to be sold. 2, it's funded on purpose for the long run. This is not a get-rich product. This is a 10, 20, 30-year vehicle. Funded consistently, the floor protects you in down years. In 2008, the index dropped around 37%. A properly structured policy credited zero instead of taking the loss. Recall that zero is your hero. Over decades, never taking the full market hit in growing, tax-deferred, changes the math. 3, the tax treatment is the actual point. Designed right, the cash value grows tax-deferred. You can access it tax-free through policy loans, and the death benefit passes income tax-free to your family. For a higher earner who's already maxed their tax advantage accounts, that is the conversation, not beat the market. Same 3 letters, IUL, completely different machine. So look, I'm not going to send you off thinking everyone should run and get one. That would make me the exact salesman I'm telling you to watch out for. Look, an IUL tool is the wrong tool for you if you haven't captured your full 401k employer match yet. That's free money. Nothing beats it. So do that first. Yes, do that first. 2, you don't have an emergency fund and your basics aren't covered. You just want the cheapest possible death benefit, then buy term and move on. Or you want pure market returns and you're fine with the risk. Buy low-cost index funds. Or you can't commit to funding it consistently for years. An underfunded IUL is the scam policy the critics warned you about. It's worth a serious conversation, however, if you're a high-income earner, a business owner, or 1099. You've already maxed your tax advantage accounts. You want tax-free income flexibility and protection from market crashes on dollars above that. You can fund it consistently and you're healthy enough to qualify. Look, if you're in the first column, I just saved you a sales pitch. If you're in the second, however, the question was never, is IUL a scam? The question is, was this policy designed for me or for the person selling it? Look, that's the whole game. The product isn't a scam. The design is where you win or lose. And the design policy is built around one of 4 things: protecting your assets, controlling your risk, growing your capital, or passing on your legacy. That's the ARC method. And it's how I evaluate every structure I build. So here's what I'll offer you. No pitch. If you already own an IUL and after this video you're not sure which kind you have, send it to me. I'll tell you honestly whether it was designed for you or for the agent who sold it. And if you're wondering whether this even fits your situation, book a strategy call at designwhatlasts.com/strategy-call. Or DM the word architect on Instagram or Facebook. I'll design around your situation. And if the honest answer is you don't need one, I'll tell you that too. Because I'm not here to sell you a product. I'm here to help you design what lasts. I'll see you on the next one.